Hey guys, welcome to the Max Invest YouTube channel, and recently in the markets there has been a very substantial dip with many stocks retracing 20%, 30% and some of the stocks even pulling back 40 or more percent. Today we're going to be looking at three interesting stocks that have dipped significantly over the past few weeks and the past few months. These stocks are high growth stocks. I will preface that I do not own any of these stocks and I may not even buy any. I am just interested in them and looking at them right now. If you enjoy the video, remember to like and subscribe, and remember nothing said in this video is financial advice and you should always do your own research. The first stock that we are going to be looking at today is Courseware Gaming. Now this is a stock that you may have heard of before and is a pretty prominent gaming stock. However, it doesn't have that big of a market cap. Now the gaming and PC market totals 36 billion and is expected to grow substantially in the upcoming years. Courseware Gaming was founded in 1994 and it has a market capitalization of 3.74 billion. This is a lot lower than other gaming stocks like Logitech and is pretty low for a company that many people have actually heard of before. Courseware Gaming is one of the leading providers of gaming gear and gear for content creators. The gaming gear is for both casuals and is for professionals, and Courseware Gaming's gear is generally considered very high quality. As we can see, it is quite a large company and has shipped 190 million gaming and streaming products, showing many people are using this company, and it is not at its market cap of speculation. In fact, it is off its market cap of its very good past performance. Now, if we take a look at its financials, we can see why this company is actually a growth stock and how it has a lot of growth in it. Its net revenue was $1.7 billion, which is an increase of 55.2% year over year, showing it is growing at a rapid rate. And it expects to continue this insane rate of growth into the future. Also, gross profit is $465.4 million, which is an increase of 107.5% year over year, which is even bigger, and over a 100% increase means you are playing with a really big growth stock. As we can see, adjusted EBITDA was also an increase of 197.5%, showing this company is only just beginning to become very profitable right now, which is great, as it shows it wasn't as profitable in the past, but it's becoming more profitable like a growth stock. However, with the recent NASDAQ correction of over 10%, a lot of these growth stocks have corrected substantially. And as we can see, Courseware Gaming has corrected over 30% from its old all-time highs in only a matter of weeks. This shows that this stock has dipped substantially and is now under a 3 billion market cap. If you are very bullish on this stock, and I do recommend you do more research on the stock, it may be a good time right now. I don't think that this stock is the best buying opportunity though, and if there is more volatility, it could continue to dip. Now the next stock we are going to be looking at is one of Cathie Wood's favorite stocks, and it is called Roku stock, a direct competitor with Amazon TV. Roku is one of the highest growth companies that there is. It was founded in 2002 and is a massive company with a market capitalization of 59 billion. It manufactures a variety of digital media players for video streaming. Roku basically operates not as a content provider or anything like Netflix. It is quite different from that. Instead, Roku is basically just a homepage of all of the entertainment that you have. So it's performing an extremely simple task of just bringing your Apple TV, Netflix, Prime Video, all of that on a very easy to access and easy to use page. Roku are also working with Hisense to make Roku TV, which of course has a range of content on it, and people like Kathy Woods have said that Roku is in fact disruptive, as Roku is not trying to be the content creator or the content streamer. Instead, it's performing a very simple task that many people want of bringing everything together in one easy place, as you can see in the bottom of the screen. Now, Roku has actually had some exponential growth, with a lot of people finding its product easy to use and wanting to use it during the pandemic. As we can see, its total revenue has grown from 411 million to 649. This is an insane growth rate in 1 year, and it represents roughly 50%. We can also see total gross profit has grown a substantial amount, nearly doubling over this year. Now let's take a look at where the analysts expect Roku to grow to. Now, the analysts see Roku as having exponential growth. In fact, the average estimate for Roku's growth is 2.55 billion in 2021 and 3.51 billion in 2022, representing 43% and 37% year-over-year growth for Roku. Even the low estimates are actually pretty good and represent some pretty high growth for Roku, so it's safe to say the analysts really believe in this stock. Now, Roku has gone up exponentially this year, going up from around $100 a share to all the way to $460 a share. However, just recently, Roku has came back 24% in the past couple of months, showing the stock has actually retraced significantly. However, Roku still does have a very high PE ratio and is currently quite a high stock right now and has the potential to drop further. The last stock we are going to be taking a look at is Lemonade. Now, Lemonade offers renters, homeowners, pet and life insurance. Renter is basically an insurance stock that is actually considered disruptive. Lemonade is generally considered a disruptive stock. It takes a flat 20% of the premium paid from you. So when you give Lemonade money for your insurance, Lemonade just outright take 20% of that and they keep it. However, the remaining 80% is used to cover insurance, and then whatever else is not used to cover insurance, like car crashes or health insurance, is then just given to charity. Now, a lot of individuals like this, as some individuals feel like it's a bit of a war between the insurance company, where the insurance company is basically trying to take as much money as possible from the people who are paying insurance. However, Lemonade have set out their terms very clearly. They're taking 20% and they're giving 80% away. It doesn't matter how many crashes there are in that year or how much insurance needs to be covered. This is what Lemonade are doing. It's very upfront, and a lot of people clearly find this to be quite open from the insurance company, and it has helped a lot of people use this insurance company, breaking down some of the traditional stereotypes of insurance companies. Now, Lemonade also consider themselves to be disruptive with their app. In Lemonade, insurance is received in just 90 seconds through an app. That is what they advertised. AI will guide individuals through the process, where all they need to do is go on the app and just message a few things, speak into the camera, and then they effectively get their insurance. This is focused on millennials who generally don't like going through the entire process of getting insurance, and it is supposed to be easy and quite fun for millennials just to get insurance from a company that they trust. And this is how Lemonade brands itself, and they have been doing quite well so far from this. Let's take a look at a little bit of Lemonade's financials. Now, recently, Lemonade's premium per customer has been increasing to $213 per customer, which is pretty solid, and their gross income and their annual loss is becoming better and better. So their financials are actually improving constantly, with gross earned being $50 million, which is nearly double this time in 2019. However, The reason this stock has been dropping is not only because of the sell-off, it is because of their customer growth. Last quarter, their customers were 940,000. However, this recent quarter, their customers were only 1 million, which is roughly 6% quarter-over-quarter growth. The people who invested in Lemonade were actually expecting a lot more growth than this growth, and this growth is considered average. It is a big growth of 56% from the previous year. However, slow quarter-over-quarter growth is not that great for Lemonade and does raise some red flags for the company. As we can see, ever since they have reported this and since the Nasdaq has been sliding, the stock has gone down 43% and is effectively just free falling and not rebounding whatsoever. If you are interested in Lemonade like I am starting to become, I do think it's possible to wait for a lower price in this stock even though it has already slid so much. It may come right back down to its level of $70 at support for the stock. However, none of this is financial advice. Lemonade is definitely one of the interesting stocks on the market right now, and this massive pullback of 43% makes it look even more interesting in the short term. If you enjoyed the video, remember to like and subscribe, and thanks for watching.